Question 1. An insured's home is damaged by a fire that was started when a neighbor, burning leaves, lost control of the blaze. The insured's company pays for the repairs, then seeks reimbursement from the neighbor. This process is known as A. Arbitration, B. Subrogation, C. Indemnity, D. Contribution. Answer: B. Subrogation. The right of subrogation allows an insurer, after paying a covered loss, to step into the shoes of the insured to recover the payment from the at-fault third party. The core concept is that the at-fault party, not the insured or their insurer, should ultimately pay for the damage. For example, if your insurer pays for your car repairs after you are rear-ended, they can then sue the other driver to get their money back. Remember this as the insurer's right to seek and recover. Question 2. Which part of an insurance policy contains the fundamental promise of the insurance company to pay for covered losses? A. The declarations, B. The insuring agreement, C. The conditions, D. The exclusions. Answer: B. The insuring agreement. The insuring agreement is the heart of the policy, outlining the insurer's essential promise to pay for losses from covered perils, provided all policy terms are met. This section specifies what is covered and describes the scope of coverage. For instance, in an auto policy, this clause states the insurer will pay for damages resulting from a collision or other specified perils. Think of the insuring agreement as the insurer's "I will" statement, where the primary promise to pay is made. Question 3. All of the following are elements required to establish a charge of negligence except A. Legal duty owed, B. Breach of legal duty, C. Proximate cause, D. Willful intent. Answer: D. Willful intent. Negligence is based on carelessness or failure to act as a reasonably prudent person would, not on a deliberate desire to cause harm. To prove negligence, one must show a legal duty was owed, that duty was breached, and the breach was the proximate cause of an injury or damage. Willful intent to cause harm elevates the act from negligence to an intentional tort, which is a different legal concept. Just remember that negligence is about being careless, not about being malicious. Question 4. A prospect for insurance intentionally conceals a history of arson convictions when applying for a new homeowner's policy. This action is an example of A. A warranty, B. A representation, C. Concealment, D. A waiver. Answer: C. Concealment. Concealment is the intentional failure to disclose a known, material fact when applying for insurance. Because the prior arson convictions are material, meaning they would have affected the insurer's decision to issue the policy, failing to mention them is a form of deception that can void the policy. This differs from a misrepresentation, which is an untrue statement, as concealment is about keeping silent on a critical fact. A good way to remember this is that concealment is hiding a relevant truth, while a misrepresentation is telling a relevant lie. Question 5. In a property insurance policy, the amount an insured must pay out of pocket on each covered loss before the insurer begins to pay is called the A. Premium, B. Co-insurance penalty, C. Limit of liability, D. Deductible. Answer: D. The deductible. A deductible is a form of risk sharing where the insured is responsible for a specified initial amount of any loss. The insurer only pays for damages that exceed this amount, up to the policy limit. For example, if a policy has a $1,000 deductible and the insured suffers a $5,000 covered loss, the insured pays the first $1,000 and the insurer pays the remaining $4,000. Think of the deductible as the portion of the risk you deduct from the insurer's payment and handle yourself. Question 6. The Terrorism Risk Insurance Act, TRIA, requires that insurers A. Offer terrorism coverage on all commercial property and casualty policies. B. Provide terrorism coverage for free on all commercial policies. C. Decline to cover any losses from certified acts of terrorism. D. Only cover acts of domestic terrorism, not foreign terrorism. Answer: A. Offer terrorism coverage on all commercial property and casualty policies. The Terrorism Risk Insurance Act, TRIA, creates a federal backstop for insurance claims related to certified acts of terrorism and compels insurers to make terrorism coverage available in their commercial property and casualty policies. Insurers must offer this coverage for a specified premium, but the policyholder can choose to reject it. The purpose of TRIA is to ensure the continued availability of commercial insurance in the face of potential catastrophic terrorist attacks. Simply put, TRIA says insurers must offer the coverage, and the government will help pay if a massive, certified event occurs. Question 7. Under a standard personal auto policy, which of the following would be covered by other than collision, comprehensive, coverage? A. The vehicle overturns on an icy road. B. The vehicle is damaged by hail during a storm. C. The vehicle is damaged when backing out of a garage and hitting a post. D. The vehicle is damaged in a head-on crash with another car. Answer: B. The vehicle is damaged by hail during a storm. Other than collision, often called comprehensive coverage, pays for direct and accidental loss to a covered auto from nearly any cause except collision or overturn. Covered perils specifically include things like fire, theft, vandalism, falling objects, and contact with an animal or bird, as well as damage from a storm like hail. The other options describe collision events, impacting another object or overturning, which would be covered under collision coverage instead. A helpful tip is to remember that if the damage isn't from a crash with an object or an overturn, it likely falls under comprehensive. Question 8. In property insurance, what is the term for the cause of a loss, such as fire, lightning, or theft? A. Hazard. B. Risk. C. Peril. D. Exposure. Answer: C. Peril. A peril is the direct cause of a loss. Insurance policies are designed to protect against financial losses resulting from specific perils, like fire, windstorm, or vandalism. In contrast, a hazard is a condition that increases the likelihood or severity of a loss from a peril, such as storing flammable materials, a hazard, near a furnace, which increases the chance of a fire, the peril. An easy way to distinguish them is to think of the peril as what caused the loss, and the hazard as why the loss was more likely to happen. Question 9. An insurer knowingly and voluntarily relinquishes a known right or privilege provided in the policy. This action is known as A. Estoppel. B. Waiver. C. Subrogation. D. Adhesion. Answer: B. Waiver. A waiver is the intentional act of giving up a known legal right provided for in a contract. When an insurer has a right, such as the right to cancel a policy for a late premium payment, but knowingly accepts the payment anyway, it has waived its right to cancel for that specific instance. For example, if your premium is due on the 1st and the insurer accepts your payment on the 10th without penalty, they have waived their right to deny a claim that occurred on the 8th due to non-payment. Here's a simple way to think about it: a waiver is when you wave goodbye to a right you could have enforced. Question 10. A temporary oral or written agreement that provides insurance coverage until a formal policy is issued is known as A. Certificate of insurance. B. Binder. C. Warranty. D. Declarations. Answer: B. Binder. A binder is a legal agreement that serves as temporary proof of insurance and is effective immediately, pending the issuance of the actual policy. It includes essential information like the names of the insured and insurer, the property covered, the coverage amounts, and the effective date. For example, a home buyer might receive a binder from their agent to prove to the mortgage lender that the property is insured for closing. Think of a binder as a placeholder policy that binds the company to provide coverage right away. Question 11. Which of the following is an example of a moral hazard? A. An individual with a history of fabricating claims applies for insurance. B. A homeowner leaves oily rags in their garage. C. A building is located in an area prone to earthquakes. D. An old, frayed electrical cord is used to power a major appliance. Answer: A. An individual with a history of fabricating claims applies for insurance. A moral hazard arises from an individual's character flaws, dishonesty, or unethical behavior that increases the chance of a loss. An applicant who has previously faked claims demonstrates a clear moral hazard because their dishonest tendencies make it more likely they will intentionally cause or exaggerate a future loss. In contrast, leaving oily rags out is a moral hazard, carelessness, and the earthquake zone is a physical hazard, a physical condition. Remember that moral hazards relate to the morality and ethics of the insured person. Question 12. Which of the following best describes the principle of indemnity? A. To restore the insured to the same financial position they were in before the loss occurred. B. To allow the insured to profit from a covered loss. C. To transfer the risk of loss from the insured to the insurer. D. To penalize the party responsible for causing the loss. Answer: A. To restore the insured to the same financial position they were in before the loss occurred. The principle of indemnity is a cornerstone of insurance, stating that a policy should not allow an insured to profit from a loss but should simply make them whole again. This means the amount paid for a loss will be limited to the actual value of the property or the extent of the financial loss at the time of the event. For example, if a 10-year-old car is totaled, indemnity means the insurer pays for the value of a 10-year-old car, not the cost of a brand new one. Think of indemnity as, to make whole, not to make better. Question 13. Which part of an insurance policy personalizes the contract by stating who is insured, what property is covered, the policy limits, and the policy period? A. Insuring agreement. B. Conditions. C. Exclusions. D. Declarations. Answer: D. Declarations. The declarations page, often the first page of the policy, contains the specific information that is unique to that particular policyholder. It answers the who, what, where, when, and how much questions of the insurance contract, including the insured's name, the property address, coverage amounts, and the dates the policy is in effect. All other policy sections, insuring agreement, conditions, exclusions, contain standardized language that applies to all policyholders with that form. Just remember that the declarations declares all the unique details for your specific policy. Question 14. An insured's responsibilities after a loss, such as giving prompt notice of claim and protecting the property from further damage, are outlined in which section of the policy? A. Declarations. B. Insuring agreement. C. Conditions. D. Exclusions. Answer: C. Conditions. The conditions section sets forth the rules, duties, and obligations that both the insured and the insurer must follow for the policy to be enforceable. This includes the insured's duties after a loss, procedures for cancellation, and the process for handling appraisal disagreements. For instance, a condition would require the policyholder to notify the police if a theft occurs and cooperate with the insurer's investigation. Think of the conditions as the rules of the game that must be followed for the contract to work as intended. Question 15. The Fair Credit Reporting Act, FCRA, gives an insurance applicant the right to A. Receive a free copy of their insurance policy annually. B. Be informed if an adverse action, such as a declination of coverage, is based on a credit report. C. Dispute their premium amount directly with a federal agency. D. Have all negative information removed from their credit report after 1 year. Answer: B. Be informed if an adverse action, such as a declination of coverage, is based on a credit report. The Fair Credit Reporting Act, FCRA, is a federal law that protects consumers by promoting the accuracy, fairness, and privacy of information in the files of consumer reporting agencies. If an insurer uses a credit report or other consumer report to deny coverage, increase premiums, or take any other adverse action, it must notify the applicant of this fact and provide them with the contact information for the reporting agency. The purpose is to ensure transparency and give the consumer a chance to review and correct any inaccurate information. A simple takeaway is that FCRA guarantees your right to know if your credit report is used against you. Question 16. In liability insurance, what is the term for a single event that results in a continuous or repeated exposure to the same general harmful conditions? A. Proximate cause. B. Occurrence. C. Pro rata liability. D. Subrogation. Answer: B. Occurrence. An occurrence is a key concept in liability policies that broadens the definition of a covered event beyond just a sudden accident to include gradual or repeated exposure to conditions that result in bodily injury or property damage. For example, if a factory slowly leaks a chemical that contaminates neighboring soil over several months, the entire contamination event would be considered one occurrence. This is crucial because policy limits are often applied on a per-occurrence basis. Remember that an occurrence can be a one-time accident or a long-term, repeated exposure. Question 17. The authority of an agent that is created when the agent oversteps their expressed authority, and the insurer does nothing to counter the public impression that such authority exists, is known as A. Express authority. B. Implied authority. C. Apparent authority. D. Fiduciary authority. Answer: C. Apparent authority. Apparent authority exists when a third party, such as a customer, reasonably believes an agent has authority to act on behalf of the insurer, even if that authority has not been expressly granted. This belief is often created by the insurer's actions or inactions, such as providing the agent with company letterhead and applications, thus creating the appearance of authority. For example, if an insurer allows an agent who can only bind auto policies to accept a premium for a homeowner's policy, the insurer may be bound by that action due to apparent authority. Think of it this way: if it appears to the public that the agent has the power, the insurer may be stuck with it. Question 18. A standard homeowner's policy, HO3, provides what type of coverage for the dwelling and the personal property? A. Broad form for both the dwelling and personal property. B. Special form for both the dwelling and personal property. C. Special form for the dwelling and broad form for the personal property. D. Basic form for the dwelling and special form for the personal property. Answer: C. Special form for the dwelling and broad form for the personal property. The HO3, the most common homeowners policy, offers two different levels of protection in one package. It provides special form or all-risk coverage on the dwelling and other structures, meaning everything is covered unless it is specifically excluded. For personal property, contents, it provides broad form or named perils coverage, which only covers losses from a list of specific perils like fire, lightning, and theft. The key memory aid for the HO3 is special for the structure, broad for the belongings. Question 19. If an insured has two separate property policies from two different insurers that cover the same property, and a loss occurs, how would the loss typically be settled? A. The policy with the higher limit pays the full loss. B. Each policy pays the full amount of the loss. C. Each policy pays a pro rata share of the loss according to its percentage of the total coverage. D. The insured can choose which policy they want to pay for the loss. Answer: C. Each policy pays a pro rata share of the loss according to its percentage of the total coverage. The other insurance clause in a property policy, often called the pro rata liability clause, specifies how losses will be handled when more than one policy covers the same property. To prevent the insured from profiting from the loss, a violation of indemnity, each policy will pay a proportion of the loss based on the share of coverage it provides relative to the total amount of insurance in force. For example, if Company A provides $100,000 of coverage and Company B provides $300,000, Company A would pay 1/4 of the loss and Company B would pay 3/4. This is simply the fair way to share the loss payment. Question 20. Under a commercial general liability, CGL, policy, coverage A provides protection for which of the following? A. Bodily injury and property damage for which the insured is legally liable. B. Personal and advertising injury liability. C. Medical payments for injuries on the insured's premises, regardless of fault. D. Damage to the insured's own property. Answer: A. Bodily injury and property damage for which the insured is legally liable. Coverage A of the CGL policy is the bodily injury and property damage liability section, which is the core of the policy's protection. It agrees to pay for damages that the insured becomes legally obligated to pay because of bodily injury or property damage to a third party caused by an occurrence. For example, if a customer slips and falls in the insured store, bodily injury, or an employee damages a client's server while working on it, property damage, coverage A would respond. Remember, A is for action, covering the financial consequences of the insured's actions that harm others or their property. Question 21. A legal liability imposed without the need to prove fault or negligence is known as A. Vicarious liability. B. Comparative negligence. C. Strict liability. D. Absolute liability. Answer: C. Strict liability. Strict liability, which includes absolute liability, holds a party legally responsible for damages or injury even if they were not negligent or at fault. This legal doctrine is typically applied to activities considered inherently dangerous, such as owning wild animals, using explosives, or manufacturing defective products. For example, if a pet tiger escapes and injures someone, the owner is held strictly liable regardless of how carefully the tiger was caged, because owning a tiger is an abnormally dangerous activity. The key takeaway is that with strict liability, fault is irrelevant, the activity itself is enough to establish liability. Question 22. In property insurance, when must insurable interest exist? A. Only at the time the policy is purchased. B. Only at the time of the loss. C. Both at the time of policy purchase and at the time of loss. D. At any point during the policy period. Answer: B. Only at the time of the loss. Insurable interest is the principle that the insured must have a financial stake in the property being insured. In other words, they must stand to suffer a direct financial loss if the property is damaged or destroyed. For property and casualty insurance, this interest must be proven at the time the loss occurs, not necessarily when the policy is first purchased. For example, you can buy a policy on a home you are in the process of purchasing, but if the sale falls through and you suffer a loss before closing, you cannot collect because you had no insurable interest at that moment. Remember, for property, you must have skin in the game when the loss actually happens. Question 23. An employer can be held legally responsible for the negligent acts of an employee committed within the course and scope of their employment. This is an example of A. Proximate cause. B. Vicarious liability. C. Contributory negligence. D. Strict liability. Answer: B. Vicarious liability. Vicarious liability is a legal doctrine where one party is held responsible for the actions of another, based on their relationship. The most common example is an employer-employee relationship, where the employer is held liable for the harm caused by an employee who is acting on the company's behalf. For instance, if a delivery driver causes an accident while making a delivery for their company, the company itself can be sued for damages. Think of a vicarious as experiencing something through someone else. In this case, the employer experiences the liability through their employee. Question 24. A formal, sworn statement made by the insured to the insurer regarding a loss, including details of the event and the amount of the claim, is called A. Binder. B. Proof of loss. C. Notice of claim. D. Waiver of premium. Answer: B. Proof of loss. A proof of loss is a formal document that the insured must complete and swear to be true after a loss occurs, as required by the policy conditions. It provides the insurer with official documentation of the facts of the loss, a list of damaged property, and the amount being claimed. This document is a critical step in the claims process, as it serves as the insured's official statement of their claim, and the insurer uses it to investigate and settle the loss. Think of the proof of loss as the official, signed evidence you provide to prove the details of your claim. Question 25. An insurer decides to terminate an insurance policy in the middle of the policy period. This action is known as A. Non-renewal. B. Rejection. C. Cancellation. D. Rescission. Answer: C. Cancellation. Cancellation is the termination of an insurance policy by either the insurer or the insured before its expiration date. This differs from non-renewal, which is a decision by the insurer not to extend coverage for another policy period after the current one expires. Cancellation during the policy term is strictly regulated and can typically only be done for specific reasons, such as non-payment of premium or a substantial change in the risk. The key distinction is that cancellation happens mid-term, while non-renewal happens at the end of the term.